So before we jump into this idea of naked short selling, right? Let's talk about short selling in and of itself. Okay, what is actually happening when a short sell occurs, and why is it relevant to what we're talking about in any of the episodes we've talked about recently? Well, when it comes to short selling, all that's happening is that you have somebody in the market that believes that a stock or any particular security, but typically a stock, will go down in value over time. They believe that it is worth less than what it is trading for today, and typically they believe it's worth substantially less than what it's trading for today. Okay, so they will take a short position. Now, before we get into a short position, a long position, right? The opposite of the short would be to purchase the shares, right? If you own shares of stock, you are long those shares of stock. But if you are short, right, you are going to take the opposite position. So long, you would benefit from the stock going up in value, but if you're short, you benefit from the stock going down in value. So how does this occur? Well, if you're going to short sell, what you would do is you would borrow shares from a broker, right? You would sell those shares to somebody who is buying in the market, right? And then you would receive cash for the fact that you sold those shares. All right. Well, the fact that you borrowed shares from somebody, eventually you are going to have to return those shares to that individual or to that investor, right? Well, you borrowed the shares, you sell the shares, right? You're sitting there, and what you do is you wait. And you wait for the shares to go down in value. And if the shares go down in value, then what you will do when you get to some point where you're like, okay, I don't know if it can go down in value anymore, you will repurchase shares from the open market at the lower price, return the shares to the individual broker that you took it from, right, that you borrowed those shares from, and then you get to keep the difference in price, right? Because instead of, in a general sense, when you're buying shares of stock, buying low and selling high, what you're doing here instead is you are selling high first and then buying low later, and you're making the difference in those two share prices, right? So that is short selling. Well, then how does short selling differ from naked short selling? Okay, well, with naked short selling, right, a seller sells stock that they don't have to a buyer who sees it in their account electronically, right? So same set of circumstances where somebody is betting on a stock to go down in value, and so they are selling, right? They're selling shares. Well, they're selling shares to a buyer who sees it in their account electronically, but it has not actually been delivered to them. Okay, the buyer gives the seller money for nothing that was delivered, right? So ultimately, what happens is these electronic trading platforms, right? They have so many shares going one way and another all the time, right? That shares can get jumbled up, right? And you can short something that doesn't actually exist. Right? Yes, the stock exists, right? Yes, the company exists, but the actual shares of stock that you shorted may not actually exist. Okay, naked short selling is the illegal practice. It is an illegal practice. That's very important to note first and foremost, that this is not legal, right? Short selling is legal, right? You can short a stock all that you want to, or within the bounds of the SEC regulations, right? But it is illegal to naked short sell, right? So naked shorting is the illegal practice of shorting shares that have not been affirmatively determined to exist. Ordinarily, traders must borrow a stock or determine that it can be borrowed before they sell it short. So naked shorting refers to short pressure on a stock that may be larger than the tradable shares in the market. So they don't necessarily confirm that they can borrow the shares that they are shorting. They just short, right? And so they are getting exposure to this particular stock and this particular stock's movement without actually having the shares outstanding in order to do so. Now, how does this come about? What makes this so prevalent? Well, like I said, there are so many shares of stock that change hand every second, every minute, right? And these electronic trading platforms want to provide liquidity, right? They want there to be markets that are able to take care of buyers and sellers and give them good prices for the shares that they want to buy or sell, right? So what they'll do is they will allow these short sellers or even buyers to purchase or sell things that aren't actually available at that given moment, because they just assume it'll be available sometime in the future. But with short selling, this can become problematic because, like I said, you can end up having the short pressure on a stock that is larger than the tradable shares in the market, meaning that you have more shares that are shorted than you have shares outstanding, which is absolutely ridiculous, right? And this really ties in directly with, when we're talking about the Reddit investors and the Wall Street bets people and the people who invest in GameStop and AMC and things like that, right? They looked at these companies and GameStop had more short sellers outstanding than they had shares outstanding, right? They had more shares shorted than they had shares outstanding, which is absurd, right? It's absurd that this actually is occurring. And if that happens, right, then that means that naked short selling is occurring. And if naked short selling is occurring, it is illegal, right? And so the SEC needs to do something to crack down on this naked shorting. Now, this was made illegal after the financial crisis of 0809. Naked shorting continues to happen because of loopholes in rules and discrepancies between paper and electronic trading systems. Now, again, naked shorting takes place when investors sell shorts associated with shares that they do not possess and have not confirmed their ability to possess. If the trade associated with the short needs to take place in order to fulfill the obligations of the position, then the trade may fail to complete within the required clearing time because the seller does not actually have access to the shares. The technique has a very high risk level, but has the potential to yield high rewards, right? While no exact system of measurement exists, many systems point to the level of trades that fail to deliver from the seller to the buyer within the mandatory stock settlement period as evidence of naked shorting. Naked shorts are believed to represent a major portion of failed trades. So if you just think about it in terms of this particular example that I'm going to give, right? Let's say you have a title on your home, right? You have a title and you could go and you could make 100 copies of that title. You could make 100 copies of the title of your home. Then you could make the decision that you wanted to sell your home, but you're going to do it 100 times, even though there's only one home, right? So the other 99 would be like naked short selling your home because there is no underlying share. There's nothing there for you to actually borrow and then sell. You are just selling this piece of paper. You're selling this right to own something that doesn't actually exist. Right? So you could see in that situation how you would have a bunch of angry buyers, right? You would have a bunch of angry individuals, and you would have a bunch of individuals who, for lack of a better term, were screwed out of their money. They would not have the asset that they thought they could get for the money that they thought they paid for it, right? Because there would be no underlying asset. You would just hold this title, and this title would be absolutely useless because there was no underlying asset, okay? So you can see how this can be viewed as just stealing.